Anybody who's ever worked with small and medium-sized businesses that in particular need to raise capital. This doesn't really fit those who don't need to raise capital, but for those that do, the universal problem that all these companies encounter is the enormous difficulty in raising such funds. And if you examine the underlying causes of that, why is it so hard, for people to go out and raise money for a small business? The key comes down to a term they call liquidity. And that is that this is an issue from the investor standpoint. And that is that, a way of sort of paraphrasing it is, this would be a question that I might ask as an investor is, if I put my money into your company, how am I going to get it out? That's what they mean by liquidity. It's a term that applies to the readiness with which I can take an asset and convert it into ready cash. Now, anybody who's bought stock, for example, on the stock market, that's a condition they refer to as liquid, that I can contact my broker or use E-Trade or whatever at any point I want to, and I'm sitting here holding a bunch of stock, I want to get rid of it, I can do so in a matter of minutes. Whereas if I invest into your company, it's a private company, by law, that the federal government, through the Securities and Exchange Commission and their laws, as well as the laws of each and every one of the 50 states, that I am restricted in being able to sell that stock to anybody at any time that I want, unless that stock has been approved in a various variety of ways, without trying to explain what that is, that the most common form of investment is in what is called restricted stock. And by very definition, that means I'm not freely allowed to go and sell it again. So if I put my money in your business, how can I get it out? That's the big question. And what this whole system is all about is addressing that very problem. Well, in order to explain the concept, let me tell you about how the idea was even first born. Several years ago, I attended a conference down in Southern California that was all about economic development, and that some pretty heavyweight, folks were there. In particular, the chief executive officer and the chief investment officer for the two largest pension funds in California, the California's employees retirement system called CalPERS, and the Teachers Association. We're talking about the biggest one, has over $200 billion worth of assets that it invests for its pensioners, its retirees. And there was a panel discussion where the two CEOs and the two CIOs were talking, and the fellow from CalPERS, the CIO from CalPERS, happened to talk about a problem that they as a pension organization had, and that this was a universal problem. All pensioner type organizations had this, and that was that in certain types of investments they do, they provide funds to organizations like venture capitalists. So they're the sort of like silent partners behind a venture capital firm that in turn takes their money and they go and invest it in a variety of companies. Well, in every venture capital portfolio, as they would call it, of investments, that a certain percentage of them will never break out of this liquidity problem that I was talking about before. The goal of a venture capital firm is to take that money, put it into companies, and at some point get what they call an exit, where they're able to convert the investment into selling it off, either through the company gets bought by somebody else, or they go public and the stock that was originally purchased by the venture capital company now is freely tradable on the marketplace, like I was talking about before, about being able to easily buy and sell shares on the market. So those liquidity events represent the way that the venture capital company gets their money back. Well, out of every, say, 10 companies that they invest in, they only have a limited number, maybe 2 or 3, that they're able to get that liquidity event for. At the other end of the spectrum, they've got companies that died entirely, so that they lost all their money. But then there's a group in the middle that they've invested in, they had big hopes for it first, but then they get to the point where they discover, no, nobody wants to buy this company, and it's not going to be big enough that it's going to go public, etc. And they have stranded investments, in those, that what I tend to call a frozen investment. And this was the problem that CIO from CalPERS was talking about, where he said that, we get money tied up in there, and as a, pension fund, our ultimate goal is to be able to get a return on the investment we do for our pensioners, pull that out so we can distribute it. Well, those kinds of investments are ones we never can recover, because of this, the illiquid characteristic. So at the end of that particular panel discussion, having just come off of putting together a particular project in association with several businesses that I had been working on, I had an idea that struck me as he was talking, and so at the question and answer point, that I stood up and I said, well, I've had an experience with dealing with that kind of an issue here recently, and I took, several companies and I put them together under one common holding company, and, we were preparing to take that public. Why don't you take a number of these companies that are, invested in by these venture capital firms and combine them under one holding company and take that public, and now everybody's able to achieve liquidity in the process. And he looked at me and said, that's a really good idea. And so it was just a spontaneous idea that I threw out off the top of my head based on some personal experiences I had. But I chatted with him briefly afterwards, and that kind of got the idea rolling around in the back of my head. And so I kept chewing on that idea over a period of time, and quickly came to realize that this problem of liquidity was not unique to pension funds and venture capital firms, but in fact is the universal problem, that many small companies are started where they go out and they'll sell stock to their family and friends as well as themselves and so on, and all of them wind up in this same problem. They have no way to get their investment back. All kinds of other investment structures, or say what they call angel investors. These are individuals who go and invest money into different companies. That's a universal problem for them. Various funds that do it, like venture capital funds, but there's a whole group called private equity, funds. They all have this problem. So this was a very universal problem out there, and that I started applying this generic idea that I presented to the chief investment officer for CalPERS, and thought, we could take that same idea and really apply it just about anywhere. So the fundamental idea here is that if you can take a group of small companies, small and medium-sized companies, that in and of themselves are not good candidates to either be bought by somebody else or to go public on their own, because especially here in the United States, it is a very difficult idea, and expensive idea and so on, to go public, even in the lowest level of the market. Even if I'm not doing what they call an IPO, so we're trying to sell a bunch of stock to everybody, but just simply want to list the company, get our shares, freely tradable up there on things like they call it the pink sheets or the over-the-counter bulletin board. That if we wanted to do that, there's a lot of work, expense, and effort, to going and bring that about. If we were to instead take a number of smaller companies and bring them together under one common company, and this is what a holding company is, by the way. A holding company is a corporation that's set up to own other things, and the things could be real estate, it could be banks, there's bank holding companies, it could be all kinds of other assets, but one of the most common is owning in part or in whole other corporations. So that was the idea. If you take and set up one common company, this holding company, that if you bring each of these individual companies in and make them what a lot of people have heard the term wholly owned subsidiaries. So this corporation basically is owned by this one parent company, that we're calling the holding company, and you do that with 3, 4, 5, 10, however many you want companies, that group now, aggregated together, has enough critical mass to justify going public, and that in fact you could set up a separate management team at the top whose sole responsibility is to deal with all the public issues, because that's another one of the barriers of why small companies don't go public, is that I can guarantee you, as a former CEO myself, that you've got a full-time job running this company all by itself. You take that company public and it's like you doubled your job. So it's a toughie for a CEO to manage all the issues related to being a public company, plus managing whatever business they're in, whatever product or service, etc. they're doing. So it's really doubling up the effort. In this scenario, we can have a dedicated team that focuses just on the public side of it, and then each of the CEOs and managers within those respective separate businesses continue to focus on running that. So that's at the core here, the idea of that you're aggregating enough so that you got enough critical mass to justify this whole group going public. You get a dedicated team that's running it, and that when you take it public, what happens is that all the people who own stock in these subsidiaries that get brought in, they exchange their stock for stock in the holding company. So when all gets said and done, the holding company picks up all the shares that are in the subsidiaries. It now gets those, and in turn, it gave its stock to all the shareholders in the individual companies. So now everybody owns the biggie all together. And that biggie goes public, and those shares either immediately or, with certain conditions over time, become freely tradable, and now you've got the answer for the liquidity for all parties in the equation. What it turns out, though, is that there's also a whole other big, huge benefit that results from this. One, in fact, two major benefits. One is that the value of the company, collective company, when it goes public, usually jumps considerably over what all the aggregate value as private companies, all those other separate companies were. And it comes back to that same liquidity question. The investor community says that if I'm going to put my money in this private company, I'm going to want a much bigger piece of it, because I can't freely sell this. So, if I'm going to take that risk, I want a bigger piece. And whereas if I buy stock in a public company, I know I can turn right around and sell it in any time, so I'm not going to demand as big a piece of that public company as I would for the private. Well, if you look historically across all the years that this has been going on, look at the industries, look at the different companies within the industries, that the rule of thumb that seems to pretty well hold consistently on the average, and some are much higher, some are much lower, but the average is that you could take the exact same company, private, market at a certain value that, this is what the investment community would say, that company's worth that. And let's just throw out a figure, $10 million, just to put a number on it, just to explain this idea. That exact same company, if it were now public, would be ranked by the public on the average 3 times the private value. So in other words, it would be valued at $30 million. So there's a huge jump in value that occurs as a result of companies going from a private status to a public status. And a companion idea to that, that I just got through saying, the price that people are willing to pay for these shares is, in essence, they're willing to pay, say, 3 times as much for the same share piece of the company if it's public. We call that the cost of capital. And that's a key characteristic of public companies, is because of this whole liquidity question and the fact that it's easy for investors to be able to pull their money back out. Stock may have gone down, so they may have lost some, but, they can at least sell it anytime they want, typically. So the cost of capital for a public company is a whole lot lower than it is for private companies on the average. So as a result, you start off with this basic situation here where, let's say we've aggregated a number of these companies here, we've taken it public, we see this big jump in value. So not only my shares that I was holding before I couldn't sell, now they're worth a lot more than it was, and I can sell them. So clearly that's a very attractive thing for the investors. From the company standpoint, this lower cost of capital, the company, the overall company, can go back to the investor community, and either by doing things like a public offering, so they openly sell it to the public. That's what an IPO stands for, is initial public offering. Once you've done your initial, you could go back and do another one. You could, say, take a big block of stock and sell it to the public. They call those follow-on offerings. So you could do that, or you could go and arrange to sell a big block of stock to one or two or a limited number of private investors on a private transaction. The company's allowed to do that. And then, depending on the nature of the arrangements of the kind of stock that was sold to those people, they then now have the freedom to be able to sell those shares in the open marketplace. And this means that the company is able to go get capital both a lot less expensively and a whole lot easier than they can as a private company. So this means that if any of these subsidiaries need money for growth, to do, technology development, whatever it might be, their cost of that capital and the difficulty of obtaining it is night and day difference from what it is as a private company. So that's one of the other key benefits that results from this. So that's the basic idea of taking a group of companies that otherwise don't have convenient access and low-cost access to capital and liquidity in the equation, and giving everybody in the equation the ability to achieve that liquidity and get lower cost of capital for the companies, etc. Well, as part of my, after I developed this idea, obviously the question is, well, how sound is it? If I'm talking about it being able to be applied in a kind of a universal sense, does it work? Do the assumptions that I'm making here, prove out in reality? So I started exploring this idea, talking with various folks, and I wound up having discussions with two separate major law firms. Each had encountered this concept themselves, not in this generic sense, but as a result of specific clients that they had that had a need, and they had come up with this solution to their particular need, and had applied it there, but just simply hadn't looked at it as a more universal solution set. They looked at it specifically for their individual circumstances. And to give you the particulars of it, that the first one was done by a major law firm out of the Los Angeles area that had a client approach them with this idea, and what they wound up doing, of all things, is they wanted to put together a public company that owned a ton of mom-and-pop laundromats. So what they did is they developed this structure of creating a holding company, and went out and pulled in a whole lot of small mom-and-pop laundromats out there, took that whole group and took it public, and the attorney that I was talking to said it worked like a champ, and that everybody was involved with it made a ton of money off of it. So that it validated the increase in value concept that I had talked about, as well as it validated the fact that they were able to get, lower cost of capital so they could grow the thing and so on, and the liquidity concept. So all the participants in it were able to realize liquidity, whereas, with a small mom and pause, the only way they could is they'd have to sell it to somebody else. So this way, everybody did realize that. That was the first instance. The second one was a Bay Area, San Francisco Bay Area law firm that had a number of firms in the San Francisco Bay Area that he didn't explain why they decided, but they decided to band together, and they put it together under a holding company and took the holding company public He said the holding company maintained a relatively low profile. You know, there wasn't, like if you call the first company that was part of this group ABC Company, everybody in the world that dealt with ABC Company continued to deal with ABC Company. That, you know, as far as the identity of that particular company and that small business that went into this, they maintained their identity. But they became part of this larger group. And so all of these shareholders, investors, and so on there were able to achieve the liquidity, but their customer base and the rest of the world knew them as that. And just like with this other laundromat one, that the concept worked like a champ. So, you know, it validated the liquidity question, the access to capital, and so on. But it, you know, was originally done with very specific purposes in mind for those individual companies. And again, not really thinking that this solution set has more universal potential application. So that's, you know, that's certainly reinforced to me that both of those attorneys said, your idea is sound. It you know, we've had the experience, it works. So that's why I am very confident this is a concept that can work. And I've just looked at it differently from the standpoint of saying, well, this has some, you know, potential universal application, so what could we do about it? Having validated the idea, having developed it, and then looking at the different elements that go into that, you know, if we're going to set up a holding company, you know, where would it be, where would we take it public, etc. After we addressed all those questions, we came to the conclusion that this was a very viable business concept that is not too difficult to put together. The big caveat, more than anything else, that just about everybody agrees, is the potential difficulty of taking disparate companies that haven't had any association together before, and in particular taking the CEOs of those and bringing them together as a cooperative group. So much depends upon the personality of the CEO in that circumstance. Can they work in a group instead of having to be king of the hill? And so that's, you know, as some people describe it, it's like trying to herd cats. That you know, we yeah, that is our single biggest problem, is finding the right mix of companies, which we're just now in the process of starting to do. You know, there's the interesting thing about this is that it creates a concept that's applicable in many different ways. The ideal is you want to bring together what I'll call an affinity group. For example, an affinity group might be a number of alternative energy companies. So there's an affinity between the different kinds of companies who all kind of complement each other in what they're doing, and it would attract a particular type of investment community, both customer group and, you know, an investor community. So we concluded this idea was a very universal one. What we're now doing is that we're working on putting together the model for our first such one, to prove out the whole concept to everybody. And our personal preference is to aggregate a group of companies that are in one form or another oriented to dealing with issues that are environmental or, you know, social issues or clean technology concepts, alternative energy, you know, that a lot of people tend to summarize as sustainability or triple bottom line oriented companies. So that's our affinity group concept that we'd like to put together, and that we've laid the foundation for where we're going to establish the holding company and where we're going to be able to take it public. And so now we're starting to talk with the various companies out there that would fit this particular affinity group model. And once we've done this, that we're looking at taking this as a prototype for how do you do this, and applying it over and over again. So, you know, the concepts again are so universal that there's widespread application. And as an entrepreneur who spent an awful lot of time building and running small companies, I intimately understand the problems that are encountered by the entrepreneur who's trying to run small and medium-sized enterprises, and especially if they have to deal with the investor community, raising funds to be able to, you know, grow the idea and get to the point of, you know, cash flow positive and so on. That just what difficulties this translates to, and I can see how universal this solution set can be for literally many, many, many small and medium-sized businesses out there, giving them a solution set they don't have on the table today. And thus, you know, when you consider that small businesses, small and medium-sized businesses, are really the main engine to the growth of our economy, whether here or really anywhere in the world, that more jobs are created in small and medium-sized businesses than are created in the big companies. So even though the big companies wield an awful lot of enormous, you know, economic power and so on, they're really not good engines for new job creation. Small companies are, but small companies struggle with this very problem, and thus we now can put on the table a solution set for those small and medium-sized businesses that has very widespread application.